Welcome to Sharp Angle. Today we're cutting through one of the most complicated yet absolutely crucial topics for everyday Americans: the Federal Reserve, interest rates, and why a speech at a quiet mountain resort called Jackson Hole can sway your mortgage payment, your credit card bill, your job prospects, and even the price of your groceries. This isn't Wall Street trivia. It's about your wallet, your plans, and your peace of mind. First, what is Jackson Hole, and why does it matter? Each year, central bankers and economists meet in Wyoming to debate the forces moving the global economy. It's not glitzy, but it's influential. When the chair of the Federal Reserve speaks there, every syllable is dissected by traders, CEOs, and yes, anyone with a 401k or a small business loan. Major outlets like Reuters, AP, and the Financial Times routinely note that a single phrase in that speech can shift markets by billions of dollars. Because the Fed isn't just another agency. It's the heartbeat monitor for America's economy. Oh, where are we now? Inflation has cooled from its worst levels, but the prices that hit home, rent, food, healthcare, and energy, remain stubbornly high. The Fed spent years raising interest rates to slow demand and bring inflation back toward its target. That's monetary policy 101. Make borrowing more expensive, people spend a bit less, price pressures ease. The danger is overdoing it. Move too slowly and inflation lingers. Push too hard and you risk a recession. The Fed is trying to land a jet on a short runway, at night, in gusty wind, with everyone on board second-guessing the pilot. Here's how that abstract debate shows up in real life. Take housing. Mortgage rates that were below 3% a few years ago jumped above 7% at times. For a middle-class family, that's the difference between buying a starter home and postponing the dream for years. Builders face higher financing costs, which slows new construction and keeps inventory tight. Rents follow the same logic. When fewer people can buy, more compete for apartments, and landlords have more pricing power. The result is a squeeze that hits young families and first-time buyers hardest. Now look at credit cards and auto loans. The average credit card APR is above 20% in many cases. Carry a balance for a few months, and the interest becomes a second rent payment. Car loans that once felt routine now come with sticker shock. Small businesses, restaurants, landscapers, home repair crews see their credit lines reset at higher rates. That can mean delayed hiring, canceled expansions, and thinner margins. For the owner and the employees, it all translates into tighter budgets. Student debt is another pressure point. Decades of rising tuition left many Americans with balances that shape every big decision: renting versus buying, moving for a job, starting a family. When rates stay high, refinancing options shrink and monthly payments bite harder. Younger voters notice their economic mood doesn't form on a spreadsheet. It forms at the kitchen table when they decide whether to take a second job to keep up. None of this is happening in a vacuum. The Fed has wrestled with versions of this challenge before. In the late 1970s, inflation became a way of life. Paul Volcker, then Fed chair, slammed on the brakes with double-digit rates. Inflation fell, but unemployment rose and businesses shuttered. 2 generations later, Ben Bernanke confronted the 2008 financial crisis with near-zero rates and bond-buying programs. That move helped prevent a depression, but critics argued it inflated asset prices and widened inequality. During the pandemic, emergency actions kept credit flowing but also set the stage for the inflation surge that followed. Jerome Powell's job today is to steer between the ghost of the 1970s and the hangover of the 2020s. There's a fiscal angle, too. The United States now carries a very large national debt. When interest rates rise, the government's interest bill rises with them. More tax dollars go to servicing past borrowing instead of funding schools, roads, or healthcare. Economists sometimes call this fiscal dominance, meaning fiscal realities start to hem in the choices of the monetary authorities. Whether that's where we are is a debate, but the math is simple. Higher rates for longer make federal budgets tougher to balance. Let's talk labor markets. For now, the United States still has a historically strong job market by many measures, though conditions can shift quickly. Wage growth has cooled from its peaks, but remains solid in many sectors. Employers complain about hiring, workers complain about affordability. High rates slow business investment and eventually cool hiring. If the Fed over-tightens, the slowdown shows up first in interest-sensitive industries: construction, real estate, durable goods. The pain is not evenly distributed. It lands on specific communities and regions before it becomes a national story. What about your retirement savings? If you have a 401k or IRA, you already know markets live on expectations. When investors bet that the Fed will cut rates, growth stocks often rally and bond yields fall. When the message is higher for longer, the reverse can happen. That doesn't mean the Fed should cater to Wall Street. In fact, part of its credibility comes from ignoring the daily gyrations. But it does mean that ordinary savers ride the waves no matter what. A cautious sentence at Jackson Hole can become a green or red day on your brokerage app. There is also the banking system to consider. Rapid rate increases can stress lenders that funded long-term assets with short-term deposits. We saw that movie not long ago when several regional banks ran into trouble. Larger banks have more buffers. Smaller ones can be vulnerable if depositors get nervous. The lesson is not that rate hikes are bad, but that transitions are risky. Policymakers try to build guardrails while they turn the wheel. Zoom out to the world stage, and the picture gets more complicated. A higher rate America usually means a stronger dollar. That's great if you're buying imported goods or traveling abroad. It's tough if you're an emerging market government that borrowed in dollars or a U.S. exporter trying to compete. Overseas, Europe and Japan have their own inflation and growth puzzles, and what the Fed does can either ease or amplify those challenges. Global supply chains, from energy to semiconductors, respond to financing costs just as surely as consumers. What are the plausible paths from here? Think in scenarios, not certainties. Scenario 1. The cautious cut. Inflation continues to drift down, growth cools but avoids a recession, and the Fed begins trimming rates later in the year. Mortgage costs ease, business lending thaws, and consumer confidence stabilizes. The risk is that inflation reaccelerates if demand revives too quickly. Scenario 2. Higher for longer. Price pressures prove sticky. The Fed keeps rates elevated to finish the job. This pathway squeezes borrowers, dents hiring, and may tip parts of the economy into contraction before the benefits arrive. The risk is an unnecessary recession that hurts households who never created the inflation to begin with. Scenario 3. A soft landing. The Fed holds steady. Inflation fades on its own as supply improves and pandemic distortions unwind, and the economy grows modestly. This is everyone's favorite ending and the hardest to deliver. It requires discipline, patience, and a little luck, and no matter which path we take, Americans feel it first through the basics: housing, food, fuel, healthcare, and jobs. That's why the debate around the Fed can't just be a technocratic seminar. It has to be about the bills that arrive on the first of the month. If you're a homeowner, you care about refinancing prospects. If you rent, you care about construction and zoning that bring more apartments online. If you run a small business, you care about credit lines, wage growth, and whether your customers can still afford your service next quarter. Politics is never far away. The Fed is independent by statute, but elected leaders frame the conversation. One side warns that cutting rates too soon will reignite inflation. The other warns that keeping rates too high will crush job creation. Governors and mayors worry about budgets, pension funds, and municipal borrowing costs. Voters don't read dot plots, they read bank statements. The political scoreboard will be tallied at the ballot box, where feelings about the economy often matter more than the statistics that describe it. Let's make this even more tangible with a few quick examples. A couple in Phoenix who qualified for a $400,000 mortgage at 3% now qualify for something closer to $300,000 at 7%. That shifts demand towards smaller homes and older neighborhoods. A trades worker in Ohio who financed a work truck at a promotional rate in 2021 faces a very different payment on a replacement today. A cafe owner in North Carolina who survived the pandemic with emergency loans now looks at higher interest costs and delays hiring a second shift. Multiplied across millions of decisions, these frictions become the economy we all live in. There's an information war aspect to this, too. Financial news emphasizes every tick in markets, while households live in monthly cycles. That time mismatch breeds frustration. If the Fed signals patience and inflation eases month by month, it may still take a long time before families feel relief. Expectations are sticky. People anchor to the lowest mortgage rate they ever saw or the highest gas price they ever paid. Policy works in the background while emotions set the headlines. What should viewers listen for when the Fed speaks at Jackson Hole? A few phrases matter. Data dependent means officials are not locked into a course. Higher for longer signals a willingness to tolerate slower growth to defeat inflation. Risk management hints that the Fed is weighing financial stability concerns alongside inflation and employment. None of these phrases guarantee action, but they shape the probabilities that drive borrowing costs in the real world. Could the Fed simply tolerate a bit more inflation? Some economists argue that aiming for a slightly higher steady rate, say 3% instead of 2%, would reduce the risk of recessions. Others counter that once you move the target, you move credibility, and expectations may drift upward in ways that are costly to reverse. Ordinary Americans don't argue about targets. They argue about whether the grocery bill finally stops rising. But credibility matters because it anchors those bills to something more predictable over time. A word on fairness. High inflation is a tax that hits hardest those who can't easily change their spending. Retirees on fixed incomes, workers living paycheck to paycheck, families with medical needs. High interest rates, on the other hand, fall more heavily on borrowers and new entrants to the housing market. Neither pain is abstract. Monetary policy asks the country to trade one kind of pain for another in service of long-term stability. That's a grim sentence, but it's honest. Now, the bigger picture. The U.S. economy has strengths most countries. Envy, innovation, deep capital markets, entrepreneurial culture, a vast internal market, and a dynamic workforce. Those strengths helped carry the nation through inflation spikes, financial crises, and a pandemic. The Fed's job is not to create those strengths, but to preserve the conditions in which they can flourish, stable prices and maximum sustainable employment. If you remember nothing else from today's episode, remember this. The Fed's tool is blunt, the effects are delayed, and the goal is stability you barely notice when it's working. So where does that leave your household today? If you have variable rate debt, consider a plan to pay it down faster. If you're eyeing a home purchase, watch both prices and rates. Sometimes a slightly lower price can offset a slightly higher rate, and vice versa. If you run a business, build a cushion for financing costs and keep lines of communication open with your lender. These are not hot stock tips. They're boring, practical steps that reduce stress no matter what the Fed decides. That will close with the human truth at the center of this story. Monetary policy is ultimately about time. How much time it takes for paychecks to catch prices, for builders to finish projects, for students to graduate into real jobs, for families to trust that the bill at the grocery store won't be higher. Again next week. A Jackson Hole speech won't solve that overnight. But clear, credible policy can shorten the wait. Welcome to Sharp Angle. Today we tried to translate central bank speak into household English. The question we'll leave you with is simple. Do you think the Fed is closer to cutting, holding, or hiking? And how would each path hit your life? Whatever your answer, the outcome will show up not on a trading floor first, but in the quiet math of your monthly budget.